We're live now with Satyam Panday. He is US Chief Economist at S&P Global Ratings, joining me from San Francisco. Satyam, a hawkish pause to a dovish hold, adding to bets that rate cuts are coming in the year ahead.
That's right, Dan. Thanks for having me back. It was a nice holiday cheer being brought by the Fed themselves. We are a little bit surprised by some of the language that came out from the press conference, as well as the FOMC's updated summary of economic projections. It leaned a little bit more dovish than what we had expected. And it was quite a pivot from the hawkish pause that we had seen back in November to what we got today was basically a dovish pause. So it seems like we are done for rate hikes for this particular tightening cycle. And now we are looking into next year for some rate cuts.
Indeed. So let's talk about them. The Fed does seem satisfied with the disinflationary trend so far. So what's your view? How soon and how deep could those rate cuts come?
So heading into this meeting, we had thought that they would probably end up at about 4.6 by the end of the next year. And that's exactly what they came out with in their own projections. Although we had thought maybe they might have one more 25 basis point rate hike, which now clearly they won't have. Nobody in the Fed funds, that FOMC participants, nobody thinks that there will be another rate hike. They are basically comfortable with the path of disinflation, that they are showing more patience with the time it will take for inflation to go from a 3% to a 2%. So that was something revealing. They also think that some of this last leg of disinflation is not going to require too much of a damage in the unemployment rate. But again, all in all, it seemed like a very nice soft landing path that they envision for the economy in the coming year. It's still, I do have to reiterate, though, that it is still a restrictive stance, even though they have pegged 3 rate cuts of 25 basis points each for 2024. They would still be in a restrictive territory for all of the year, in fact. And that should be cooling down the economy nevertheless.
Indeed, and I think it's really fascinating to also just counter this and look at ultimately what it all means for Chair Powell's soft landing, something that markets have been speculating on for several months now, given the risks to the outlook moving forward and these new projections around what possible cuts are going to look like. So when it comes to the updated summary of economic projections and forecasts, where does it ultimately leave growth and inflation in the year ahead, and how does it compare to your own numbers?
So ultimately, in the year ahead, for next year, they themselves are forecasting a year-over-year, fourth quarter, a forecast for the GDP growth of 1.5, 1.4%, which is very close to, a lot of other new forecasts that have been coming out in the last 2 weeks are showing we ourselves are more closer to the 1%. We're a little bit weaker than the Fed themselves are showing. But still, the inflation forecasts, we have it pretty much the same, going back down towards, 2% by the end of this year. The unemployment rate is where the Fed thinks that there won't be too much of a climb in unemployment rate in this process, which we think that it'll probably go up to 4.4, 4.5, but the Fed thinks they're going to be sort of around 4.1% by the end of this whole rate, rate cycle. Again, there are lots of uncertainties in these forecasts. These rate projections themselves are based on your macro forecasts and the response to the macro variables that you have put in place. So there is plenty of scope for surprises in the coming year. But again, at this point in time, it seems it's quite reasonable to see that the economy having a soft landing, what the Fed has kind of sort of shown to us and what we also were expecting to begin with.